Well, welcome to PeakTV. I'm Niv Dagan, Executive Director of Peak Asset Management, and we're fortunate enough here to have Ashley Moore, CEO of ESI, here in the office. Ashley, thanks very much for joining us.
Thanks for having me.
Terrific. Ashley, tell us a little bit more about who ESI is and a bit more about the company.
Right, ESI is actually our stock ticker. The company name is Environmental Clean Technologies. That's too much of a mouthful, so ECT is what we refer to ourselves as. We're a technology development and commercialisation company. We work in the energy and the resource space. We use our mix of engineering skills to de-risk and upscale and progress our technologies through a very disciplined science and engineering heavy commercialisation pathway with a view to getting either licensing royalties or revenues or any sort of manner of commercial realisation out of our technologies as we get them through to deployment.
Okay, terrific. And tell us more about the technologies you are actually developing in the market.
Sure. We have two key technologies that we're focused on. In the energy sector, we work with coal dry technology. It's the name is a bit of an agglomeration of what the technology does. It's a drying technology for coal that operates at low temperature. So coal, cold, dry, so on. That's the origins of the name anyway. It's a very energy efficient means of taking the water out of brown coals or lignites.
Mm-hmm.
What you create then is a much more energy dense material that when you use it, it's much more efficient. You've climbed up the value chain in terms of the value of the resource, and in the process, and as you use it more efficiently, you actually also decrease the CO2 footprint associated with that resource. In the resource space, we have another technology called MATMOR. It's an iron production technology or a crude steel production technology, an alternative to blast furnace. It uses lower cost raw materials, some might say lower value, but lower cost raw materials. It achieves the reduction from the oxide form to the metallic form of iron in a much more efficient way. We use a different chemical pathway to achieve that outcome. And in so doing, that efficiency generates also CO2 savings associated with the production of crude steel. So you have a raw material saving, very significant, a capital saving associated with the more efficient technology, and also an environmental footprint improvement. So they're the two technologies that we have. In essence, those two technologies create value in exactly the same way. They take low-grade resources and move them up the value curve because they're essentially upgrading technologies. In both cases, the products of those technologies or the raw materials those technologies use can help economies or nations avoid importing more expensive alternatives from overseas where they don't have them. And thirdly, where there's either commercial or political value associated with decreasing your CO2 footprint, they also add value in that area as well.
And actually, why India? I mean, obviously India is a big point of difference for you and a lot of the energy and focus of the firm, but tell us why India and why the NLC more specifically.
Sure. We put together that value model that I talked about, resources climbing the value chain, avoidance of imports and CO2 footprint reduction. As we compared all of the nations across the world that had the combination of resources and would value those facets, India became a standout winner almost in its own right just at that stage.
Mm-hmm.
Then we added into the equation the very high quality engineering skills that you can obtain in India. There's some fantastic domestic firms in India. Not only do they have highly skilled and sector-specific engineering expertise that sometimes we find difficult to find here in Australia, they have also backward integrated into fabrication, so you've got world-class cost structure associated with the fabrication of the equipment that you would use in deploying those technologies. And India is very renowned, at least in our little sector of the world, for frugal innovation. So creating technology improvements in a very with a low-cost mindset. We find great affinity with that. So that's why India. Why NLC? NLC is Neyveli Lignite Corporation, one of our partners in India. They essentially have under their control, they own over 70% of the lignite reserves in India and manage on behalf of the central government the balance of those reserves. So that if you want to do anything in the lignite or the brown coal space in India, NLC is necessarily a focus. They're also interested in upgrading through the value curve, not just upgrading their lignites, but looking for higher value applications.
Mm-hmm.
So they're a logical potential customer or partner in the development of both coal dry technology and MATMOR technology. given that we're talking about technologies in the metal space as well, we're also working with NMDC. NMDC are the largest iron ore miner in India. They're also a government-owned company. They are downstream integrated into the steel business. So one of their core technology development areas is looking for ways to decrease reliance on coking coal, because India has no coking coal. Mapmore technology doesn't need coking coal, so there's an obvious interest there in terms of, let's say, parallel interests. As we started talking with these two parties, it became very clear that working with one or the other would be fantastic. Working with, as a three-party arrangement actually would be much more powerful again. And that's the genesis of what we've just signed last week, which was the Tripartite Technology Collaboration Agreement.
And actually, can you tell us more a bit about the Tripartite Agreement? What does it actually mean for the company and sort of the market opportunity as a whole?
Right, in essence, it's the most significant step forward in terms of commercialising our technology. We now have, on the other side of the table to us, two companies in aggregate value of more than $10 billion, both interested in the same technology space we are, both wanting to climb their resources up the value curve, both recognising the strategic benefits to India of the technologies as you would use them in their organisations. What we've started under the Tripartite Agreement is a methodical pathway through to the eventual commercialisation and deployment in India with those companies. And it all starts with the first activity, which in fact I'm heading off to India again tomorrow to start work on, which is the techno-economic feasibility study, where we look at the value of these two technologies when deployed at commercial scale. We look at the cost that it takes to get to that point where they're ready to go commercial, do a simple economic analysis on that, and that then justifies obviously the commercial commitments each party will make to the subsequent deployment, the demonstration plants and the further progress through that commercialisation pathway. And it will allow us to have those detailed conversations about who's putting in how much capital, how that's structured, how do we share the benefits, and so on.
Sure. And what are the next steps? I mean, you obviously highlighted you're off to India tomorrow to discuss that in more detail. Can you elaborate a little bit, what are the next steps for that company?
That techno-economic feasibility study is the effort that we'll be in a place to conclude that by the end of June.
Okay.
That will deliver to our partners and ourselves a definitive report on capital that it takes to get to the commercialisation point, the benefits that are available with these technologies when they're commercialised. It'll recommend investment structures and strategies to progress to that project, and we'll even lay out a more detailed agreement again that takes us through the construction, commissioning, optimisation and eventual operations of those facilities. So that's work that we're getting done in this next 6 months.
Fantastic. And today there was a pretty important announcement just regarding the debt facility. Can you elaborate a little bit more about that?
Sure, that stitches in with our capital management plan. What we've done in the last couple of months is we've received our last year's Oz Industry R&D tax incentive rebate. We've put to bed through a conversion into equity $1.5 million in debt that we had set up as a facility. We've got our options conversion program. We have also listed alongside our headstock 2 option series. There's a facilitated conversion program in place which has delivered about $2 million to us so far. And add to that, then we've just established and announced that this morning another debt facility with a company called Brevet Capital Management. They're a New York-based debt funder. Great company to work with, but most importantly, they're a company of sufficient size and capability that well, we might have an R&D based working capital structure that we've established now, but they're able to articulate that into a much bigger funding structure around large capital projects for R&D demonstration over a number of years. And so the fact that we've started that relationship is great, but more importantly, as we look forward, they're the right party to carry that through. And not having a chop and change as we go through and grow is of great benefit to us, and so that's what we announced this morning.
So actually it seems like there's a huge opportunity and the company's definitely heading in the right direction, and congratulations on the Tripartite Agreement and obviously today's debt facility that you did sign, so that's great milestones. Is there anything else you'd like to add?
Sure, there's a lot of things happening at the company. I think in addition to wrapping up our capital management plan, we've got a lot of activity happening at our Bacchus Marsh pilot plant facility. We're upgrading our cold dry pilot plant to a higher volume test facility so we can do, let's say, more aggressive testing to support our scale up with cold dry. That will also produce, obviously, more finished product as we do that higher volume side of it. That allows us to then look at using some of that produced material to serve the solid fuels market in Victoria. A little bit of revenue there helps offset the cost of our R&D, so that will be that'll be a nice little contribution to our budget. We're upgrading our Matmore test facility. It's not a fully fledged pilot plant, but it's a much smaller semi-continuous plant, so we're upgrading that to assist with our upscale engineering to the pilot plant development program. That's work that's underway at the moment. We're also doing some fundamental developments on the Matmore side, so we're creating some new intellectual property. We believe it's got some patentable features, and so we're exploring that at the moment. And then lastly, but certainly not leastly, we're looking at downstream applications and the potential for those in Victoria. So once you process the material for the brown and coal material, you have, as I said before, much more energy dense, much higher value material. You can use that in higher efficiency power stations. We think there's more value to be obtained though in taking a next upgrade step again, potentially producing synthetic natural gases, fertilisers, or very high value char products for traditional steel making. So we've got feasibility studies in the early stages across each of those areas, and that's another piece of the work that we've got going on at ECT.
Ashley, you've covered a lot today, so I want to say thank you very much for joining us here at Peak Asset Management, and wish you all the very best.
Thanks a lot.
Thank you. Cheers.